Today, September 3rd, 2025, the U.S. stock market continues to show many complex fluctuations when investor sentiment is dominated by both negative and positive factors. In the latest trading session, all three major Wall Street indexes fell. The S&P 500 lost about 0.7%. The Nasdaq Composite fell nearly 0.8%. And the Dow Jones also fell more than 0.6%. The main reason did not come from corporate earnings, but from the global bond market. The yield on the 30-year U.S. Treasury bond briefly exceeded 5%, its highest level in many years. When yields rise, bonds become more attractive than stocks. The cost of capital for businesses is also higher, and the valuation of stocks, based on the discounted cash flow model, becomes less attractive. This situation has created a wave of drafts in the market, while raising concerns about the burden of public debt and fiscal sustainability of the U.S. Rising bond yields often have multiple consequences. First, money flows out of stocks into safer debt instruments. Second, companies, especially growth companies, face greater pressure to raise capital cheaply. Third, the entire stock market. Valuation is at risk of a sharp correction. However, rising yields also indicate inflation expectations and the Federal Reserve's balance sheet and monetary policy. This is a double-edged sword that investors need to watch carefully. Despite the overall gloomy market picture, technology stocks have been a bright spot. Most notably, Alphabet, Google's parent company, rose more than 5% after a major antitrust ruling. The court did not require Google to release its Chrome browser, as many feared, but forced the company to share data with rivals. This was seen as a compromise, helping investors avoid legal risks. Apple shares also rose nearly 3% on expectations for new integrated products. Another notable point was Scalar, a cybersecurity company, which announced a fourth-quarter financial report that beat expectations and increased revenue forecasts, thanks to the development of an AI security truth. Their shares rose more than 3%. These positive signals show that, despite the general pressure, the big tech group is still an important support for the market. Outside of tech, the market saw other moves. Health equity jumped more than 4% after reporting strong second-quarter earnings, while broker plunged as much as 11% after announcing a $600 million convertible bond issue, raising concerns about dilution. Figma, a publicly traded wallet, rose 1.3% ahead of its first earnings report, reflecting the market's appetite for new tech companies. The picture is stark. Companies that perform well are rewarded by the market, while those that issue additional capital are often punished. Meanwhile, gold prices continue to set new records. This is clear evidence of the safe haven trend. Investors are worried about instability, and money flows heavily into gold for protection. The continuous increase in gold prices shows that the defensive sentiment is dominant, and this could be a factor that puts more pressure on the stock market. Analysts believe that the current risks come from three major aspects. First, the over-reliance on technology and AI groups makes the market vulnerable to stock market fluctuations. Second, rising bond yields directly threaten valuations and the ability to maintain profit growth. Third, the U.S. public debt burden continues to raise big questions about long-term sustainability. In addition, upcoming economic data, especially the employment report and non-farm payrolls later this week, will have a direct impact on expectations of the Fed's interest rate policy, thereby strongly affecting the market. In summary, the U.S. stock market is in a state of mixed. Hot and cold today, pressure from the bond market, and the government debt market is dragging the market down. But good news from big tech and some individual stocks still brings a ray of hope. Gold prices hit a new high, showing that investors are very cautious, ready to defend against fluctuations. In the short term, investors need to maintain caution, focus on risk management, and closely monitor economic data, as well as the Fed's moves. This is a time when defensive strategies and patience may be more important than seeking quick profits.